Investing in the stock market can seem daunting, especially with the overwhelming influx of information and advice dominating discussions today. As traders aim for success, they often fall victim to investing in popular stocks that may not yield the promised returns. As we navigate through the complexities of stock analysis, it's vital to dissect some well-known companies whose popularity is betraying their current performance, leading to potentially dangerous investment decisions for 2025. Understanding the environment in which a stock operates is crucial. Factors such as declining revenue and profitability signal a company's struggle to keep investor trust. Meanwhile, overwhelming debt can be a heavy chain, often stifling growth and innovation, particularly in a climate where interest is rising. Insight into market trends is essential. Industries oscillate in favor and disfavor, compelling investors to reconsider their stakes. Poor management erodes confidence, exposing vulnerabilities that affect stock prices. Lastly, overvaluation is a looming threat, where a stock's inflated price creates a false sense of security, ultimately leaving investors at risk when reality sets in. Diving into specifics, one notable example lies with Plug Power. Plug. Initially riding the wave of enthusiasm for clean energy, the company now battles significant challenges. With a price drop of 19% over the past year and 59% in just 6 months, Plug Power faces a stark reality of an investor base that is shifting its focus from clean energy to more lucrative sectors like AI and semiconductors. Furthermore, the company struggles with profitability while relying heavily on unpredictable subsidies. Until there's a clear turnaround in its financial health, investing in Plug Power remains a high-risk proposition. Similarly, Ford F, a household name in the automotive industry, finds itself reeling from changing tides in the electric vehicle space. The stock has stumbled with a 15% drop over the last 6 months and a 24% decline in the past year as it grapples with fierce competition and outdated strategies. Consequently, it may not promise the robust growth that investors expect. In conclusion, the allure of popular stocks can often cloud judgment and lead to detrimental investment choices. Investors should scrutinize the financial health and market dynamics before buying into high-flying names. Armed with insights into the factors that contribute to a stock's decline, one can avoid the pitfalls of underperforming investments and make informed decisions. For a more resilient portfolio, choices must be grounded in research, recognizing that popularity does not guarantee prosperity. In recent times, investors are expressing concern over several key players in the automotive and technology sectors. Ford, a name synonymous with American car manufacturing, is currently facing a storm of challenges that make it a questionable investment. The company's profit margins are diminishing as it invests heavily in the transition to electric vehicles, EVs, which, while crucial for future growth, come at a significant cost. The competition in the EV arena is fierce. Rivals such as Tesla and foreign automakers continuously innovate, leaving Ford scrambling to keep pace. With a major stock drop in July 2024, the market reacted unfavorably, indicating a wavering investor confidence that raises further questions about recovery prospects. Similarly, in the semiconductor world, Advanced Micro Devices, AMD, finds itself in a precarious position. After dropping 25% in the last 6 months and an alarming 48% over the past year, AMD's performance starkly contrasts with that of NVIDIA, which is thriving in the AI chip market, a crucial growth sector. This underperformance draws harsh scrutiny as AMD loses market share to more aggressive competitors like Intel and NVIDIA. In a cyclical industry, AMD is clearly facing a downturn, making it a risky choice for investors without clear signs of recovery on the horizon. Another electric vehicle manufacturer, Lucid Motors, presents its own set of red flags. With its stock now under the $5 mark, Lucid has shifted into penny stock territory, a domain rife with volatility and potential manipulation. The company is grappling with significant cash burn without corresponding revenue, an alarming trend that raises doubts about its viability. Compounded by a broader slowdown in the EV market and increasing price competition, Lucid's outlook appears bleak, limiting its appeal for cautious investors seeking stability. Lastly, Intel, once a titan in the semiconductor field, is wrestling with innovation challenges that may jeopardize its future. Despite a recent uptick in stock price, the reality is clear. Intel has fallen behind NVIDIA and AMD in the high-stakes race of advanced chip technology, particularly in AI. While government support from the CHIPS Act may provide temporary relief, it has not sufficiently boosted Intel's performance in a highly competitive landscape dominated by Taiwan Semiconductor, manufacturing company without significant innovative breakthroughs. Intel's journey toward triumph in the market looks arduous at best. Overall, the present landscape surrounding these companies is fraught with uncertainty, offering little incentive for prudent investors. In the fast-paced world of technology, supermicrocomputer, SMCI, stands out as a captivating prospect. Recently, this stock made headlines not just for its impressive 177% surge over the past 6 months, but also for the significant 54% decline it experienced within the last year. This contrasting performance has turned heads, prompting investors to reconsider their stance on the company. Supermicro's journey reflects the volatile landscape of the tech industry, where fortunes can shift dramatically in short spans of time. The culprit behind the drastic fall was serious accounting issues, which provoked skepticism within the investment community. The dark cloud of financial reporting concerns led to a sharp decline in stock prices, pushing many would-be investors to the sidelines. However, as the dust settles, a glimmer of recovery emerges. Investors have begun to regain confidence, pushing the stock upwards. Observing this rebound raises the question, is it time to jump on the bandwagon? Or does caution still reign supreme? Investing in SMCI comes with inherent risks, magnified by its tumultuous past. Yet if the company successfully addresses its financial ambiguity, it could potentially regain investor trust and further enhance its value. For prospective investors seeking undervalued stocks, 3 key indicators warrant attention. First, one must monitor earnings growth, as consistent revenue trends often signal recovery. Second, robust insider buying by company. Executives can hint at a solid future, indicating that those who know the business best believe in its potential. Finally, keeping an eye on market sentiment, especially regarding institutional investors, can provide insights into when confidence might be returning to the stock. These elements are crucial for determining if SMCI has truly hit its low point or if there's further to fall. In conclusion, successful investing hinges on careful research and strategic decisions. Rather than passively following popularity, discerning investors should focus on company fundamentals and long-term growth prospects. While brands like Ford, Lucid, and Plug Power must grapple with broader industry challenges, SMCI's signs of recovery suggest it may be worth monitoring. Always remember, due diligence is key in deciphering good investments from the plethora of bad ones. The road to recovery is rarely straightforward, but in the realm of stocks, intelligence often leads to triumph. Supermicrocomputer SMCI has captured the attention of investors, especially in light of its dramatic 6-month surge of 177%. Despite this impressive rebound, the looming shadow of a 54% decline over the past year raises questions about the sustainability of this recovery and the overall health of the company. Recent months have been tumultuous for SMCI, primarily due to a massive drop resulting from accounting issues that eroded investor trust. The fallout from these financial reporting concerns significantly impacted the company's stock price, causing many to question its reliability and future prospects. However, the renewed vigor in the stock price has sparked optimism among those tracking potential recovery plays in the tech sector. Investing in SMCI now entails a nuanced approach. Though it remains a high-risk endeavor, the stock's recent performance and the potential resolution of financial issues could signal the opportunity for investors to recoup their losses. To gauge if the stock is primed for a true turnaround, investors should keep an eye on critical indicators signaling a low point for the stock. One such indicator is earnings growth. A continuous increase in revenue and earnings can solidify confidence that SMCI is on the path to recovery. Another significant marker is insider buying. When executives of the company allocate their own funds to purchase shares, it radiates confidence in the firm's future. Lastly, improving market sentiment, especially if large institutional investors start to participate again, will be telling of a strong potential turnaround. These elements paint a picture that could validate a comeback for SMCI. As we consider SMCI's momentum, it's vital for investors to approach the stock market with discernment rather than impulse. It is essential to remember that not all popular stocks are sound investments. Companies like Ford, Lucid, and Plug Power are facing broad industry challenges, while AMD and Intel seem on shaky ground compared to their rivals. SMCI is hinting at recovery, but potential investors must continue their research before making any commitments. Investing successfully hinges on patience, thorough research, and strategic choices. Rather than investing blindly in trending stocks, it's prudent to focus on those with robust fundamentals and a clear trajectory for long-term growth. As the landscape shifts, enhancing one's knowledge of the market will empower better decision-making. Ultimately, understanding the deeper mechanics of stocks like Supermicrocomputer will be key to navigating its volatile nature.